Good morning, everyone. Thank you so much for joining us. I'm Nikki Jovicic from LookUpStrata. I'm also the Managing Director of Tower Body Corporate, and I'll be hosting this session. Join us today as we step back to take a national view of the big picture changes currently reshaping the strata management industry. Our session is led by Michael Teys, who brings over 4 decades of experience as a strata management business owner, lawyer, and educator. Michael will guide us through the tough new market forces strata managers are navigating, from pricing models and industry restructures to wellbeing challenges and tech disruption. We'll examine how strata businesses are responding to these pressures, including shifting towards fee-for-service models, the rise of offshoring, the implications of vertical integration, and the recent announcement that SCA New South Wales will begin phasing out insurance commissions from January 2026. Michael will also share insights into how artificial intelligence is being adopted across the sector and what private equity roll-ups could mean for the future of strata. Now, if you're joining us today as a lot owner or committee member, we hope this session gives you a clearer understanding of the strata management company that you're working with and whether their approach is the right fit for your building. And it's also an opportunity to gain insights into the pressures managers face and how broader industry changes may impact service delivery at your scheme. And if you're a strata manager or business owner in the sector who's feeling the pressure or wondering how these national trends might impact your operations, today's session is for you. Michael's presentation will run for around about 35 minutes, and then we'll follow that with a live Q&A where we'll address some of your questions. The content we're sharing is general in nature. It doesn't constitute legal or professional advice. And if you have a specific issue, we do encourage you to seek independent advice. So let's meet today's presenter. We're very pleased to welcome Michael Teys. He's a strata industry veteran with over 40 years experience as a business owner, lawyer, and academic researcher. He has a law degree and a Master of Philosophy in Built Environment, focusing on the management of mixed-use developments, and now consults and runs training programs for strata managers across the country. Michael is a familiar name in the industry and has long been a thought leader on the evolution of strata practice and policy. So welcome, Michael. It's really great to have you here.
Thank you, Nikki, and welcome everyone to this session. A year ago, almost to the day, the Strata Trap aired on the ABC. This was an investigative piece on strata management practice that, in my opinion, marked the beginning of the end of the business model that most strata managers across Australia are still using. That is, charging for their services by a combination of fixed fee, hourly rates, commissions, and related party transactions. Today, I'm going to call that old strata. In this presentation, I want to do 5 things. Firstly, I want to prove beyond doubt that the current business model is broken. Secondly, I want to identify 11 market forces that are outside the control of strata managers that are contributing to the demise of what I call old strata. Thirdly, I want to describe how strata managers are reacting to these forces, looking at what managers are doing and, more importantly, what they're not doing. Fourthly, I want to explain how new entrants, including those backed by private equity, are working to disrupt old strata. And fifthly, I want to outline what managers will have to do to stay in the game and become strata firms of the future. However, first I want to bring some context to the discussion by dispelling the myth that the new business environment in which we are operating is just about insurance commissions. Insurance commissions, if you're following the chat on social media, have been the dominant part of this discussion, and you would be forgiven for thinking that the pressure on managers is just about insurance commissions. Nothing could be further from the truth. Insurance commissions are just the tip of the iceberg. Just about every element of the old strata business model is under investigation. This includes interest by strata managers in insurance brokerage, related party transactions with facilities management companies that they own, the free or subsidized software that is being made available to people in response to committing to certain banking arrangements and payment systems, kickbacks that are being paid for reports and energy readings, law firms and consultants that are offering training and sponsorship to strata managers in return for referrals, Schedule B charges being split with staff as part of their, and work being done by strata managers for developers in return for an initial appointments. In the coming weeks, Dr. Nicole Johnson will release the results of her research into strata conflicts and the state of relationships between strata managers and owners. This work has been commissioned by the New South Wales government. In her trademark way, Nicole's report will be extensive, it will be factual, and it will be fiercely independent. You can expect that it will uncover new conflicts that have never before been identified and discussed publicly. And you can also expect that there will be more press and more scrutiny on strata managers as a result of this. Now, I know that this will anger some managers. I understand this. Anger is normal as we grieve the loss of something that is important to us. But my point is this: it is only when we rid ourselves of these bad practices that we can rebuild trust between owners and managers and get better outcomes for all in strata. If we need any proof that the business model is broken, then this chart will provide that proof. When I began in strata management in 1985, the average fee was $120 per lot per annum, and you got that much again for insurance commissions and additional charges. Life was good, profit margins were where they should be, at about a third of revenue. So in those days, there was a third of revenue for staff wages, a third for overheads, and a third for profit. If we'd stayed on that trajectory, and only increased that fee by CPI, we would be at $800 per lot today, and we'd be heading to $1,000 per lot per annum by 2031. Margins would still be good, our staff would be fairly paid, and owners might even be getting their calls and emails returned promptly. Instead, look at where we are. Fees are sitting at about half of that mark at $453 on average, total revenue per lot. Profitability is plummeting from 33% in 2005 to 23% in 2022. And this is mainly because wages have risen from a third of revenue to about 50% of revenue. But getting more work and paying people more is not solving the problem. The Macquarie Benchmark Report of 2024 proves for the first time in strata history that getting bigger doesn't make you stronger. For further proof that old strata is broken, we need only look at the latest figures on Australian job turnover. The broken workforce is demonstrated by these figures from the Australian job turnover data produced by AI Group. If we look at this, we can see across the nation the amount of turnover in a number of industries. And you'll note that all industries sit at about 7.7%. Real estate services are down at 5.5%. However, look at the strata figures. We sit at a whopping 33% in 2022. And nothing has got better in the 3 years since the last available figures. This means strata is at 328% higher than the national average for turnover. Houston, we have a problem. The figures also tell us that matters have got worse in the last decade. From 2011 to 2022, our turnover has more than doubled. Now, estimates vary on the cost per resignation. Some credible consultants put it as high as 1.5 times the annual salary of the person leaving by the time we recruit, retrain, and settle staff and clients to a new order. This type of impact on revenue is consistent with the fall in profitability we looked at earlier. It's not just increasing wages that is our problem, it is compounded by the cost of turnover. And when we consider the market forces in play in the current environment in which strata managers work, these disturbing figures are not surprising. I've identified 11 major forces that are impacting strata managers at the moment, all of which are beyond their control. If we start with aging buildings, we know from the City Futures Research Centre that more than 50% of our buildings are now more than 25 years old. Aging buildings take more time, more effort, and more money to manage. Overlaid on this, we have a maintenance funding crisis, and I spoke about this at the recent Strata Impact Conference. This is a worldwide problem where most academics and researchers now accept that providing for the repair and maintenance of buildings and for their future capital works is beyond the financial resources of the current owners, because for so long, owners have kicked the can down the road and not taken their obligations to repair and maintain properly. We have sustainability retrofits causing issues for strata managers, with EV charging stations and other equipment like this taking a lot of time and causing a lot of conflict amongst owners in buildings, which needs to be managed. Building defects are prevalent. We know that from the last 2 decades of poor building practice, we have over $10.5 billion worth of repairs still to be undertaken on buildings that are built in the last 10 years. Those figures come from Equity Economics. We have an aging population, and an aging population requires retrofitting of accessibility and disability infrastructure. This is a difficult issue for us to manage, and one that is getting harder. Some people argue about who pays for this. Other people argue about what this does to amenity and say that they don't want to live in something that looks like a nursing home. Interestingly, cost of living and the housing crisis have impacted on strata management in recent times and shifted the political dynamic. We are now under the scrutiny of the federal government and state governments more than ever before, because strata is being linked as a necessary ingredient to both the cost of living crisis and the supply of housing. So much so that the head of the ACCC, perhaps the most powerful regulator in the country, has now said that strata commissions and conflicted arrangements must be eliminated altogether. We have never had the attention of the federal government like we have at the moment. The housing crisis, the cost of living, will play out as very important factors on the reform of strata management in coming times. Buildings are getting more complex. 9.3% of new residential housing across the nation exists now in mixed-use complexes. This provides greater complexity for strata managers and a lot of heartache for investors in these buildings. And of course, we have technological advancement and AI to deal with. In 1985, when I started and the figures were at 120 per lot per annum plus extras, there was no email, there were no mobile phones, and there was no Google on which people could leave reviews about how unhappy they were with the outcomes in their strata buildings. This presents real challenges for us. And last but not least, let's talk about consumer anger in the era of entitlement. Where does this come from? I was recently at a Darrell Lea chocolate store buying some chocolates when I noticed a sign that said, "Please do not disrespect our staff," and "zero tolerance of aggressive behaviour." And I thought to myself, what have we become? When you can't be happy buying chocolates, we really do have a problem. It comes largely from a lack of transparency. Strata managers think that transparency comes from making disclosure of a commission, but transparency in the eyes of a consumer is much more than this. It's about having certainty about what services are being rendered, how they're being done, and how they're being priced. Transparency understood this way is why people like me and so many others, for example, love Uber. We can see the progress. We know what car is coming and what driver we're getting. We know how much it's going to cost, and we have certainty that we're going to get to our destination within the required amount of time. Certainty builds trust. Now, research on service firms that are not transparent have shown a sharp rise in uncertainty, leading to negative consumer emotion and suspicion. Using a 7-point scale, a 2015 study found uncertainty rose to 5.9 out of 7 for non-transparent firms, against 1.64 for transparent firms. Now, this explains mounting anger and complaint rates seen in all sorts of service settings, including in strata management. It's transparency understood in this way, or the lack of it, that I think is at the heart of the change from old strata to new strata. Quite apart from opaque charging practices that are currently under threat for strata managers, Transparency is a difficult issue for strata managers because of the operating structure and style of owners' corporations and bodies corporate. Strata managers are judged by owners in a general meeting, although their service is mainly delivered and seen by only one or two people on the committee. And this is something which we need to look at. So what are strata managers doing and how are they adapting to the new environment? In our advisory business, we examine strata management on three fronts: pricing, people, and process. We're definitely seeing a move to commission-free models. It's slow, it's small, but it's on. This is easiest for new entrants that are peeling out of big strata, as they always have, and setting up new businesses. They're setting up these businesses without ever having been on the drug that is commission income. Those that are weaning themselves off of commission income are doing so by using very careful cash flow forecasting. Some are refunding strata commissions that had been paid in the previous 6 months to avoid any suggestion that the increased fee is a double dip. Some are getting overdrafts to see out the 2 to 3 year period that we think this will take for this type of income to be eliminated without sending businesses broke. In other progress on pricing, we're seeing managers offer bundled packages. Think in terms of flying first class or business class or economy. These bundled packages are helping re-establish trust and set new conversations and narratives with owners' corporations. In terms of managing related party transactions to get away from conflicts altogether, there's been little activity. And the three things that I've shown in this chart in the box are where I think there's been less activity than in other areas. In terms of reducing conflict by getting rid of related party transactions, at the big end of town, we've seen Brighton Duggan, or its holding company, more particularly John Ling's group, exit their insurance brokerages. So Steadfast shares in the holding company were sold about a year ago, which really represents a major commitment to moving forward to a conflict-free environment. In other businesses, we're yet to see that. We're still seeing facilities management companies, law firms, debt collection agencies, repair and maintenance companies, fire safety auditor companies, all sorts of people still owned or conflicted in their relationships with strata managers. This is the next area that will be a major focus and attention. In terms of how we manage people, the response largely to the decrease in profit has been to offshore, to engage people in the Philippines, Sri Lanka, and India, working for much cheaper rates than staff in Australia. Offshoring has produced variable outcomes. Like any form of delegation, offshoring requires quality input in order to get quality output. Some strata managers are challenged by this. Other committees are challenged by this. There are ethical issues involved in offshoring that upset some, and very few strata managers are letting the offshore teams have direct contact with clients. Again, in terms of people, some strata managers have begun renegotiating their packaged arrangements with strata managers. Although recently I did see a leading strata recruitment company still offering a split of additional fee income as part of the remuneration package. The McGrath-Nicol report into the conflicts at NAT strata as a result of the ABC investigations highlighted this to be a conflict of interest, similarly to the Banking Royal Commission, which found the same thing in relation to banks and financial services. So some people are moving to renegotiate. What people are not doing in relation to their human resources is making sure that there's an alignment between people and process. And by that, I mean, are the right people doing the right job on the right remuneration packages? And confusion about that, and we'll talk about that in a moment, is something that is yet to be really embraced, I think, across the board. In terms of process, we're seeing some technological advances, although mainly coming from new entrants or relatively new entrants rather than the traditional owners of strata management software. Ticketing services have emerged, which is helping visibility, helping build trust. Ticketing services assign a number and a place to a particular issue and allow all sorts of people, including committees, owners, and tenants, to monitor the progress of the work and to see the communications in relation to that work in one place. The other benefit of ticketing services is, of course, it enables you at the time of renewal to talk to your clients about how many jobs have been done and at what cost and at what price and for what outcome. So this is really helping make the invisible visible, which I think is critical. We're also seeing the emergence of mobile-first apps so that people can interact with their strata managers on their phone as they're traveling home. What we're not seeing in relation to process is a focus on operating procedures. Operating procedures are incredibly important to the future of strata management because we have to standardize and critically analyze what is being done in various offices by different teams to get a better process, a faster process, and a more consistent process. So in terms of activity towards a better service, there is some movement, but there's also some big issues ahead, including eliminating vertical integration, getting greater alignment between people and process, and improving operating procedures. As a consequence of this turmoil and this change, there is new interest in strata management from private equity groups. For the uninitiated, private equity is funds of high net worth individuals and institutions that are investing in businesses that are privately owned and operated and that are not on the stock exchange. The relationship between private equity and the stock exchange is symbiotic. Private equity often unloads an investment by listing it on the stock exchange, and they will often buy something on the stock exchange and take it private in order to give it greater flexibility. Private equity like to acquire a majority stake. Sometimes they'll take a minority, but more often than not, they want a majority. They take an active role in the management and the restructuring of business. They focus on value creation, and they like to get out of their investment between 5 and 7 years. Private equity has re-emerged in the strata market, most demonstrably by recent announcements that the John Ling Group, which own and operate Bright & Duggan and Stewart Silver King and Burns, SSKB, Pacific Equity Partners, which is Australia's largest private equity firm, has acquired the entirety of John Ling's group for 1.1 billion. That transaction goes to shareholders later in October and will receive unanimous support from the directors and major shareholders and likely to happen. So as a consequence of that, a private equity firm will own the second largest strata management entity, and one that I note yesterday announced an acquisition in New Zealand. So private equity is back. There's other private equity players looking at strata management at the moment that have yet to enter, but are looking to buy firms and are looking to start firms. So private equity is going to change strata management in the coming years. There's another model that might do something as well, and that I call the aggregation business model. Under this model, think Uber, think Airbnb. The business entrepreneurs will establish a platform and partner with existing providers. They'll provide services, but not management. They'll look for market scale, customer access, and they'll look for brand strength. At the moment, I can't see an aggregator of this nature in the business, but I'm predicting that one will emerge pretty shortly. So in this environment where we have falling profitability, stagnant price increase, horrendous staff turnover, serious worldwide factors that are troubling strata managers and challenging strata managers to deliver good services for a sustainable, profitable price. With private equity and others looking at disruption, the question arises, what do strata managers who want to stay in the game have to do to build the strata management firm of the future? This is the professional service spectrum, which is published or adopted by Harvard and emerged in 2021. And what it does is it describes professional service firms in 4 dimensions: commodity work, procedural work, grey hair work, and rocket science. Commodity work is that work which is standardized, routine, simple. So in strata management, think of things like updating strata roles, handling simple PET inquiries, handling inquiries about when levies are due, etc. Commodity work in strata management at the moment is sometimes done offshore, is sometimes done in the office. Procedural work is work that requires some expertise. So in the context of strata management, that would include, for example, putting together a set of papers for an AGM, doing a budget, handling relatively simple repair and maintenance work. So a lot of the work that strata management presently does is in the procedural area. Grey hair work is where leveraged experience and expertise is brought to a task. In strata management, grey hair work might mean solving a particularly difficult repair and maintenance problem. It might mean restoring the financial affairs of a body corporate or owners corporation that you've taken from someone else to a positive place. It's that type of work that is principally done by the owner of the business or by the senior strata management in the business. Finally, rocket science is really cutting edge and innovative stuff. And there's very little of this done, frankly, in strata management firms. Rocket science in strata management is really the type of work that we saw David Chandler undertake in Opal Tower and in Mascot Towers, where people are working at the cutting edge of doing deals between owners corporations and banks and developers in buildings that are past their use by date. That's the best example I can think of rocket science work. So at the moment, what we see is strata management is mainly in the commodity and procedural area, with a little bit of work in grey hair and not much rocket science. I can see problems with this at the moment because sometimes we have commodity work being done by people who should be doing procedural work and procedural work being done by people that should be doing commodity work. Now, the problem with that misalignment is that people are not doing the work that they're best suited to do, and they're not always being paid appropriately for the type of work they're doing. So getting alignment between people, process, and pricing is really important. In the strata firm of the future, commodity work, I think, will be more likely done by AI than by offshore workers. Offshore working, I think, is at risk as a consequence of the rapid development of AI. At the moment, AI in strata management is more at the interpretive stage, where chatbots are being used, where open AI is being used to critique things and to prepare emails and to prepare marketing material. But we are emerging from that to agentics, where AI will actually do tasks. In our business at the moment, we're experimenting with this and we're having some success in getting AI to actually automate some of the work that is commodity work by strata managers at the moment. Procedural work, I think, will also largely pass to AI. People are working at the moment on AI to conduct an entire meeting for a small strata scheme without any human involvement. When that happens, procedural work will pass from strata managers to AI with human intervention, but the type of efficiency that we're seeing worldwide is about 3 to 1. So when procedural work passes to AI agentics and robots are doing much of what strata managers do in a procedural sense now, the staff efficiency should go from 3 to 1. So one person will be doing the work of 3 people at the moment in that field. So that leaves staff to be elevated, to be doing more grey hair work and to be doing more rocket science work. And this is what strata owners want to see happen. They want strata managers to be more involved in project management, but not in an amateurish way, in a more with more expertise, doing project management with real project management skills, so that repair and maintenance, retrofitting, renovations, remediation of building defects is really being done with appropriate expertise and appropriate experience. So the shift will be from commodity to more sophisticated work being done by people, hopefully at fair prices, which will satisfy both strata managers and strata owners. And that's the future that I look forward to. That's the future that I think will be the strata firm of the future and will be what people are presently looking for. Thanks, Nikki.
Thank you, Michael. Very, very interesting. The very last slide that you had on that talked about the grey hair and the rocket science part of the role. We had a bit of a discussion going on while you were speaking about the value of the strata manager. And for me, that's where I can see the value of the strata manager really coming to light.
Absolutely. Yes, I think that's the future. And it's a good future. I mean, there's a lot of doom and gloom around at the moment, and part of my presentation went to that. But I think that's necessary to understand context. But the future is bright. The future is that this industry has enormous opportunity to make a difference, to do something positive, to really impact the way people live, and benefit from that themselves. So far from being despondent, I'm happy about the future. It's only out of chaos that comes certainty. And I think we're right in the middle of the chaotic period at the moment, but there is a light at the end of the tunnel.
Yeah, I would agree with that too, Michael. I think we also had a bit of a discussion going on about the doom and gloom that you were speaking about when you mentioned the strata trap and how the light was shone on the bad players in the industry. The challenges is creating opportunities for those people that are out there doing the right thing. And I think we have seen a lot of that over the last couple of years. One of the comments that came up, I pulled it out to have a bit of a chat with you about it when you were speaking about the profitability and you were showing us the graph. Particularly, a comment was put in chat that said 23% profitability, Crimea River. Consumers complain about supermarket price gouging and they aren't that profitable.
Look, I think 20 to 30% profitability for a business that is hard and a business that takes substantial risk is appropriate. Now, if supermarkets and builders and other people want to work for margins less than that, that's a matter for them. But strata management is tough. It's a very tough game. 150 emails overnight from people who aren't writing to you to tell you how good you are. They're writing to have a whinge, is very tough. And the other thing about it is that it's very risky. Strata managers, particularly those with delegation of strata powers, are right in the firing line. Now, in the past, that hasn't really mattered, but in the present circumstances where buildings are defective, where buildings are old, and where buildings are underfunded, that presents real risks. So I think 22% is low. It should be higher than that for the risk that's being taken and for the effort that's being taken. And owners that don't understand that and don't respect that are not going to ever get what they want.
If you're an owner in a building, I think you need to be working with a profitable strata management company.
Absolutely.
Because if you're not, then that company won't be there in the future for you, and it won't be able to pay your strata managers a valuable amount for the work that they're doing, and that strata manager will move on.
That's right. And on that point, Nikki, in America, there are strata schemes that can't find a manager. Managers are just saying, we won't manage you. We can't manage you at that rate. And so, that's a reality in America, and I can see it coming here too.
And it's a concern for the profitability of the industry to drop off because less people will open new businesses, and then we're just limiting the strata managers, which is the point that you're making there. And then you just won't be able to find strata managers to manage the buildings.
That's right. And I think the graph I showed about job turnover for me is really very significant. And I think everyone, including me, has failed to focus enough on that. But those figures are horrendous. If we're at 33% turnover and the rest of Australia is at 7.7, what does that tell you about our business model? What does that tell you about, you know, the way we're treating staff members? It means that, you know, this is breaking point stuff, and we're seeing that. We're seeing social impact. You know, the abuse of strata managers by owners is becoming unacceptable, and those figures demonstrate it.
And I think the other part of the conversation, of course, is if they're going to be profitable businesses and good businesses, then you have to up that game and give that really great service and that value that you'd spoken about in that final slide to do with the grey hair work and the rocket science work. That's really where we need to be heading.
Strata managers should start wearing white coats to work.
Yes. Let's float that idea. Okay, we'll go back to one of the other questions that was sent in to us. So, who are the private equity firms aggregating strata management companies, and what sort of dual metrics or multiples, etc., are you seeing? Any insight into the type of margins the average strata management company is seeing, which we've kind of spoken about as well, and related trends?
Look, the only transaction of record at the moment since about 2020 is the Pacific Equity Partners acquisition of John Ling's group, which I spoke about. And then prior to that, when John Ling bought SSKB and Brighton Duggan. So they're the major player at the moment. As I say, there are others. I'm conflicted on that and can't tell you who they are, but there are others looking. The SSKB Brighton Duggan transaction was an interesting one. The SSKB EBITDA, that's future earnings, was said to be 9 million. The price paid was in cash and shares. It totaled about 44 million. The cash payment was 28 million, and there's an earnout, the maximum of which might be 16 million. So on those numbers, the EBITDA was 3.2 on the cash and about 4.9 on the maximum payout. So that's not that high for private equity. Private equity would sometimes pay 6, 7, 8 times earnings for a well-structured, well-run business. So that probably reflects, in my opinion, that they see strata management as challenging, interesting but challenging. Challenging in terms of being able to get scale. And one of the things I think that has challenged private equity in the past, and other people that have done aggregation, is that it's been a slow build. So private equity likes to be in and out within 5 to 7 years. Management businesses take it it's a slow build because owners, corporations are slow to change managers.
Okay. And are we seeing as many new players coming into the market as we're seeing being purchased up by larger companies?
Look, I think the acquisition by the larger companies has obviously been the dominant trend in the last 5 years. But certainly the private equity people are gearing up and ready to go. As I said, John Ling announced yesterday Brighton Duggan's bought something in New Zealand, which is interesting. So even under takeover by the private equity, they're out there and they're doing stuff. So I think that's interesting. So yes, I think we're transitioning. I think trade buyouts will still be on. Although they're difficult at the moment because of insurance commission under threat and other income. If the income under threat moves from insurance commissions to other vertically integrated related party transactions, which I think it will, then I think we'll see a bit of a stalling, perhaps, of trade buyouts while people sit back and say, how is this going to work out?
Okay, yeah, because there's a bit of uncertainty there at the moment.
Sure.
Okay, so what if the insurance commission currently paid to the strata manager was passed on to the strata company to reduce the actual premium cost, benefiting the strata owners? It would be up to the strata manager to charge the strata company by adjusting their management fees or including an administrative fee for service in administering the insurance requirements. Would this work?
That's been going on for a number of years, and it's complex to explain to strata committees. But it's not needed now, I don't think, because we've got insurers that have got zero commission packages, and so people can go to an insurer directly now. There was a time when you couldn't do that, or it wasn't understood that you could do it, and that's why that practice emerged. So it's been done, it's been tried, it's no longer necessary. And also, it doesn't address the cultural issue of commissions. We have to get away from thinking about commissions. Whilst ever we think about commissions, we are trapped in the past. And we have to get away from that.
Our committee has just reviewed several management proposals that structure fees differently. Some include insurance commissions, others don't. Some charge heavily for extras like fire compliance and meeting attendance. What's the best way for committees to assess and compare these apples to orange proposals in a fair and transparent way?
This has been a problem for many, many years, and I think explains why some people change managers and get upset that they're not getting what they want. They don't know what questions to ask. So the way to do this is to produce your own schedule before you go out to tender or before you go out shopping, and make prospects answer your proposal, not submit their proposal. And if they're not prepared to do that, then they're not for you. Amanda Farmer has published a very good list, I think, of about 20 questions that committees should be asking strata managers. So I'd recommend that people get a hold of that and prepare a question and answer form and say, this is how we want, we're not interested in your 10-page proposal telling us how transparent and wonderful and committed you are to blah, 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 blah on board. We want real answers to real questions. And strata managers who can do that and can do it confidently and forthrightly are going to win the business. So that's what I would suggest. I'd caution strata owners about using consultants, brokerages. There are strata consultants that will work on a fee-for-service basis and provide services to owners, corporations that pay for it. And I think that's valuable. But the brokers that say they act for an owner's corporation but take their money from the strata manager is bad practice. And again, we must get away from commissions. We must get away from this opaqueness.
Is the Strata Act in WA and also other acts around Australia intending updates to approve the use of AI voice to text or recording of council of owner or committee meetings for accuracy or reporting and documentation, such as action registers, AGM minutes, etc.?
Fascinating question. And it's a fascinating question because government doesn't need to do those things. That's not the role of government. I think what that question highlights for me is this dependency that strata sector has on legislation. Every time something happens bad, we think government should fix it. We think more regulation should fix it. The Queensland strata laws at the moment comprise 568 pages of legislation. That is absolutely ridiculous. So we've got to get away from this notion that we need to go to government for everything. You don't need to go to government to buy Fathom for $20 per month to have it take your minutes of a strata committee meeting and produce them within 45 seconds. And I can promise you that they are the best minutes you will ever read from a strata manager. I've tested it, I'm using it, my clients are using it. It's outstanding. And I've also looked at the law right across states and territories, and it satisfies every strata law in the country. There's nothing in the strata laws of this country that says that the minutes have to be produced in the way they've traditionally been done. So we have to think differently. We have to embrace these things. Now, I've put this to some strata managers and they've laughed at me. They look at me as if I've got two heads because they can't imagine working in an environment where minutes are done by a machine. But they're better. They're better than the strata minutes I've seen. This is the sort of change in thinking that we're going through at the moment. And it's difficult for people to accept that. But if you don't get with the program, and even if they're not as good as the strata manager, minutes within 45 seconds with action items is better than a correct set of minutes that comes 6 weeks later. So, near enough is often good enough. Perfection is not the answer. But I encourage people to look at that. But we don't need laws that do this. The only thing I am concerned about is a bit of public information and sensitive information going into the internet. I think that needs some thought. And back to offshoring, I think in New South Wales, at least, where there's licensing and supervision guidelines, some of the offshoring could be an issue. where the offshore team is doing more than administrative work and is actually delving into strata management work.
Okay, well, that certainly with Fathom, that's piqued my interest. I'll check that out. Excuse me, and have a look at that. Yeah,
Life-changing. And I also think it sort of lends itself to strata managers actually not attending committee meetings. Because what Fathom does is it tracks the dialogue as well as the outcomes. And, I think in a lot of cases, strata management firms spend a lot of time at meetings that for issues they don't need to be involved in. And we can look at the outcomes of the meeting and act upon them. And again, when we're looking at profitability and we're looking at pricing and we're looking at staffing, and one of the difficult things about strata management is working after hours for meetings, even though we now don't have to get in a car and go to the outskirts of the town. We do put a lot on people by having meetings at 6:30 when we're trying to feed kids and dogs and partners and ourselves, and thinking of ways to change the way we offer the service but give a better service is what we need to be doing.
Yeah, I think you said life-changing. I would agree. I think that it could change the life of Australian strata manager. It's not only the time that they're spending in that meeting, it's all of the time that they're spending after that meeting with the actions, and they're getting the minutes out, as you said. I think if just that one thing changes in the strata manager's life by in the next 6 months, then that's a really positive change that could have a massive impact on a company.
I have no financial interest in Fathom. I'm just a happy user.
No, yeah. That's fine. Thank you for that disclosure. Yeah, but I'll definitely check it out. I hope everybody else here does as well. That's fantastic. With more businesses exploring fee-for-service models, do you think this shift will eventually become standard across the industry, or are we still a long way off from moving beyond all-inclusive agreements?
The shift is on. As I've said, I think the transformation of this is 2 to 3 years. If we start now, and some people have, I think if laws are passed saying that commission's gone, then it could happen faster because committees will demand that. It's interesting to study what happened in financial planning. When financial planning weaned itself off commissions and went fee for service, it took between 1 and 3 years. Some got there faster than others. And interestingly, I wrote about this in my newsletter last weekend. Members of SCA ACT have led the charge really and said, we're just getting on with it. We want government to outlaw it, but we're getting on with it. And some of the bigger firms in Canberra are really well down the track of eliminating commissions. Yeah, it will happen at different pace and at different times, but we will get there. I think the question referred to all-inclusive fees. That might not necessarily happen. We might have fixed fees still for commodity, going to my chart about the 4 different types of work we do. We might have fixed fees for commodity and hourly rates for other things. But the point is we need to get away from conflicts of interest payments, commissions and related party transactions.
Couldn't agree more. Okay, well, that leads us right up to the end of the session. We always like to ask our presenters at this point if they'd like to just leave us with some final thoughts, Michael. So what can you leave us with at this point?
Look, I'd encourage both strata managers and owners to have discussions about transparency. Transparency is a much used word, but it's a much misunderstood word. But what people need to do is have a discussion about transparency. And some of the people that are peeling out of the big strata firms and setting up their own without commissions are having the discussions with their clients, and it's creating a point of difference for them. So if you're taking commissions and you've got related party transactions and you're not talking to people, then you're going to lose. So, but I'd also say to owners who are there listening, be reasonable. You're not going to get strata management for less than you're paying today. Strata management fees are going to go up, just like the price of your apartment has gone up. And we need to stop this notion of asking for things for free and expecting strata managers to absorb costs every time a law's changed and further work is created. So that discussion needs to be had, and it needs to be respectful, and it needs to be commercially rational.
So owners recognize the value of your strata manager that you're dealing with. If you've got a good one, hang on
And
to
that,
them.
and that might require strata managers to up their game.
That's it.
You know, it takes two to tango. And at the moment, we're not seeing that. And I think a lot of discussion needs to be had and a lot of reality. But, you know, owners demanding more for less is not the future. Strata managers demanding respect and demanding more money is not the future. We have to have a negotiation, and that can only happen with good, constructive conversation.